So Tim, today we're discussing how the Australian Taxation Office is impacting investors and property owners. So tell me how the ATO is going about collecting tax.
The ATO have recently released what they call their compliance program, and one of the elements in that may well affect property owners is what they've called a data matching project. Just to explain what that term might mean, is it basically goes along the lines of comparing the information that's provided to other external sources, or particularly other government departments, and then the ATO goes through the process of comparing that with the information that taxpayers have reported in their returns. Now, that can obviously affect property owners and investors, and in particular, one of the announcements that was made quite recently, in fact it was late last month, they stated that they're actually going back and looking at all property transactions, property sales, since July 1999. So it's quite an extensive project they've engaged in there.
So given that the ATO are increasing their use of data matching, was it just a matter of time before this information was used by the ATO?
That's probably true. It was to be expected, of course. However, perhaps what is surprising with the whole project is the fact that it actually is such a large-scale project. I mean, going back to 1999 was perhaps quite surprising due to the fact that the ATO actually don't have an unlimited opportunity to adjust tax returns that they believe aren't quite accurate. They're basically restricted to between 2 and 4 years to make those types of adjustments. So going back to 1999 does seem a little surprising.
So why would the ATO collect information back that far?
I should have said when talking about the ATO's ability to adjust tax returns, there is an exclusion there for events where they deem there to be fraud and evasion, which is obviously the more serious end of the spectrum. And obviously there may be some implication there that the ATO are expecting to find some of that type of activity. However, the other elements that could also be relevant is in determining how certain property transactions are treated, history of how a taxpayer has behaved is also relevant. I mean, one example people might be familiar with is the fact that someone conducting a business of property development is treated differently from someone who just sells one sole property by itself. And that can be quite significant due to the fact that in some cases that might mean that the tax is up to double what would otherwise be levied. So by going back to 1999, I think the ATO might be looking to see if they can get a bit of a picture of the history of a particular taxpayer so that they can actually use that in looking at that particular window of 2 to 4 years.
So what are some other likely implications for property owners or investors?
Well, I guess we've been talking primarily about gain or taxing of capital gains on properties. However, the other thing that you need to be aware of, investors would need to be aware of, is the fact that there's also GST to consider. So that actually means that you might have sold a property that didn't have any gain at all, and the ATO could still come to a position that suggesting that you haven't paid enough tax. So there's the GST side of things as well.
So what should taxpayers do if they get a query from the ATO?
Well, perhaps I should answer that question by saying even before taxpayers get a query from the ATO, if they are, for whatever reason, aware of a transaction which they might not be entirely sure was reported correctly, the time to act is probably now, due to the fact that a significant element of these types of activities, or at least the tax that arises from these types of activities, relates to penalties, which can actually be up to almost double the underlying tax. So it can be quite significant. So if a taxpayer acts now and voluntarily discloses an error or an omission to the tax office, there's a good chance that those amounts will actually be remitted. But if it gets to the situation where the ATO contacts them first, I guess depending on the amount of money involved, I'd definitely suggest getting in touch with your accountant. But the other thing that people have to be aware of is there are a number of exemptions. It's not just a fait accompli that you've made a gain on a property, you have to pay tax. Obviously, the one that most people would be aware of would be the exemption on your family home. If you sell your main residence, there should be no tax in that. But, however, once you get into a situation where you've got a property that you use partly for your home and partly rented out, it can get quite complex. So maybe that's another situation where they'd like to, might be worthwhile seeking some professional advice.